This is BASSET group, a past year question from the AA exam. And we're going to have a look at the requirement of the question. This is a question 1. So in part A of the question, it says to evaluate the audit risks to be considered in planning the audit of the group financial statements. And they're only giving you 14 marks. Now, if this question was to be done now, the marks would probably be something like 24. Let's have a look at the next part of the question. It says to identify and explain the matters which the audit team should approach with a high degree of skepticism. Now, when the examiner says identify and explain, identify would be probably half a mark, and to explain the matter would be 1 mark. So that'd be 1.5 marks. So if you look at the 9 marks here, if you divide it by 1.5 marks, then you should be able to get 6 points inside here. Now, the first part of the question is on audit risk, and the second part of the question is on the matters, and they're giving you separate marks. So I would deal with these two things separately in the exam. Now, when it says to identify the matters which the audit team should approach with skepticism, I'm just going to color that in a different color so that when I deal with the scenario, I would be able to highlight them in this color, and I would be able to easily pick up these points when I start writing out the answer. And it says to assist the audit assistant's understanding of our audit strategy in respect to BASSET, to explain the term significant component, and this is a group audit question. So significant component here is a technical term that is found in ACCA 600. The two kinds of significant component, one is financially significant and the other one is non-financially significant. So you've got to explain that term and then make an assessment whether BASSET is a significant component of the group or whether it is a non-significant component. So that one you'll have to have a look at the facts from the question to be able to see whether this particular company is a significant component or not. Next, we're going to discuss the nature and the extent of the involvement which our firm should have with risk assessment to be performed by Saluki Associates. Now, I'm guessing that Saluki Associates would probably be the component auditor. They're giving you 8 marks here. Normally, when the examiner says to discuss, it would be 2 marks per point, but let's see how it goes. They're giving you 8 marks for the whole part 1 and part 2 here. So let's see how it goes. All right. Now let's go and read the top of the question. We know it's an audit risk question. So in reading the audit risk question, how are you going to find these points? Well, I use a particular technique called DADS, dash with an R. So what does this stand for? This is just to help you to find the items in the scenario. That's all. So the first D stands for dollar value, which means that I'm going to go through the scenario and I'm going to highlight all the items that have a dollar value in yellow, and if they have a dollar value, then I should be able to calculate materiality. And remember, for audit risk questions, at the moment, the maximum marks given for materiality is 4. Next, we're going to have a look at the accounting treatment. That means anything, even if it does not have a dollar value, see whether there is anything that relates to a particular accounting standard. Then we are going to look at other points within the scenario where the examiner says during the year certain new things have happened. Sometimes the examiner may not say during the year, they might actually use a particular month, but from that month, you should be able to see whether it was during the year or not. Okay. Then you have got S. S stands for the area of significant risk. Now in ACCA 315, significant risks have actually been defined as being these 6 areas. So let me just explain what those 6 areas are. These acronyms just help me to organize things inside my head, that's all. Okay, I'm sure you already know those points, but I'm just arranging it just to make sure that I don't miss anything out. So what does F stand for? F is fraudulent financial reporting. So to look out for any instances where there might be creative accounting. U stands for unusual transactions and is any kind of new developments that are happening during the year. So when you're talking about new developments, that during the year is the same thing. All right. Then you've got complex transactions. So what kind of complex transactions do we have? So if they've got things like derivatives, that is complex. Then you've got accounting estimates involving a high degree of uncertainty. And normally if it's accounting estimates, we are going to relate that together with the IFRS anyway. But anyway, we'll have a look at that. So what are the accounting estimates involving a high degree of uncertainty? These are accounting estimates involving net present value, expected value, fair value, value in use. These are kind of things that involve significant amount of management judgment involved. Then you've got the last R, under fund CAR, and that stands for related party transactions. Now let's go back to DADS R. In DADS R, we've got this R here. So what is that? That one is to do with revenue. And the reason why I've put that down there is because of ISA 240 on fraud that requires us to presume that there is fraud in the area of revenue recognition. So I'm just getting ready. I'm not saying that that is going to be included inside the answer. I'm just saying that we just have to be aware of these points before we go in and read the question. But there are other points that we need to consider as well. And what I'll do here is I'll just put down 3 alphabets here called P and B. So what does P and B stand for? This first P here is about whether the company is a private company or a listed company, that one. Because if it's a listed company, then there are several things that we have to consider. Number one, whether there's an issue of management bias, if it's a listed company. Because when the results are going down, management may try and carry out inappropriate accounting to increase the profit figure. So that is whether it's private or listed. This one is whether it is new or old, because if it's a new client, then we've got 2 points that we can bring inside here. The first one is on the area of detection risk, and the other one is on the area of the opening balances. But remember, if this question was an ROMM question, we cannot bring in the point on the area of detection risk. And B stands for just to be aware of whether it is before the year end or after the year end. So usually question 1 is before the year end, but just have a look. All right, just to make sure. So let's go and read the scenario here. And reading, we are going to try and build up our answer. So I've already opened up a worksheet. So if you're doing this in the exam, you'd probably open up 2 columns if you're doing paper-based exams, or if you are already on the CBE, then you're going to open up a table. You can either use a scratch pad, or you can open up a table inside your answer, and then after you finish writing out the answer, just delete the whole table itself. So let's begin. It says, the BASSET Group is a publisher of newspapers and magazines, academic journals, and books. So it's a publisher. And one of the things that we need to consider with a publisher is the point about the revenue recognition. But I'm not going to put that in unless I've got further information inside the scenario that hints that there might be improper recognition of revenue. Otherwise, it's just a speculative risk. So I'm just being aware of the fact that it's a publisher of newspapers and magazines. The group is a listed entity, it says here. So I'm just going to be aware of that. So this one is a listed company. And once I knew it's a listed company, I am going to have a look at the results. So here you've got some results here, and we've got revenue last year, this year, and we've got total assets last year, this year. And they've not given us a PBT, at least I can't see it for the moment. And here, revenue seems to have gone down. If overall revenue has gone down by 3.2%, then it's very likely that the profit before tax would also be going down, thereby impacting your profit after tax and your earnings per share. So management bias might come in. So the first thing I'm going to do here is I'm going to put down my point about the listed company, the thing about management bias here. However, because this question also has got skepticism in part 2, part 2, and there are separate marks being given, what I'm going to do is I'm just going to transfer this onto the other side. because now I will have to exercise professional skepticism to make sure that there is no management bias being introduced into accounting estimates, and some other things as well, but we'll discuss about that later. Okay, but just now you saw that there was decline in the revenue, right? So we can actually put down our first point down here, and that would be on the area of PPE might actually be impaired. You can actually see that revenue has actually gone down, which is an indicator of impairment. So let's go back to the question. It says it has a financial year ending of 30th April. I colored my year end in pink, and I only use pink highlighter just for that purpose, so that in the exam I would be able to easily track down the dates if necessary. So here the year ending is 30th April. Now once I know that that is the year, then the next thing that I'm going to do is I'm going to have a look at the date of the exam. So here year ending is April and the date of the exam here is March, which means that it is before the year end. So what if it's before the year end? Now I'm going to go down to the numbers again here, and I'm going to go and look to see the P&L items, whether it is projected or not. So here it is projected figures, which is really good because then I do not have to gross up any of the figures here. It is already projected to 12 months. Moving down, it says annual firm Whippet was appointed as auditor in September 2017, which is actually during the year. So this is a new client. So if that's the case, then I'm going to go back to my worksheet here, and I'm going to put down here the second point. This is a new client. And my first point will be on the area of detection risk. And I can put down another point here on the area of new client, and that is on the area of the opening balances and the comparatives. Going back to the question. It says Whippet will audit all of the group companies with the exception of Borzoi, a foreign subsidiary, which is audited by a local firm of auditors, Saluki Associates, and the group aims to comply fully with relevant corporate governance requirements. Okay, fair enough, but we've got this foreign subsidiary here, and I just want to put a question mark here on the currency that is used in that particular country, because there have been past exam questions where they say that the functional currency is exactly the same as the parent. In that particular case, we're not going to bring in IAS 21, but in the event that it is different, then yes, we can bring in 2 points. One is the translation of the results during the year, and the other one is the retranslation of the assets and liabilities of the foreign sub at the end of the year. And we have to go and find this information, whether the currency is the same or not. Okay, so don't jump the gun, just go and find the exact information. It says here, you're the manager responsible of the group audit, and the audit engagement partners just sent the following mail to you. Remember, this is an old format question. I mean, it's not really that old, it's 2018, but the format has changed. So this one would probably be in Appendix 1, the email from the engagement partner. It says, I provided you with some information to help you with the planning of BASSET Group. I met with the group finance director yesterday to discuss some aspects of the group's business and related accounting issues. One of the audit team members has already performed limited analytical procedures based on the group's projected financial statements and comparatives, and I provided you with the results of this work. Now, just one point here. When the examiner tells you that the audit team members have already performed analytical procedures, you are supposed to take them as being correct. We're not going to criticize any of the analytical procedures done. Okay, to turn around and say, oh, the gross profit margin could be incorrectly calculated or what. We are not going to say that because they've been calculated by our own audit team members. Okay, and I provided you with the results of this work. I've also provided you with an extract from the communication which we received from Gray, the group's previous auditor. Okay, we'll see what that is. It says, I would like you to prepare briefing notes to be used, so that will be the title of the document, to be used as part of the audit team planning meeting. Your briefing notes should evaluate the audit risks. And in doing this, in the evaluation itself, we're going to use an exam technique. And I'll show you how. And then identify and explain matters which the audit team should approach with a high degree of professional skepticism, and we've not found any yet. And to assist the audit assistant's understanding of our audit strategy in respect of BOSOI, the explanation of significant component, and then to talk about the extent of the involvement. So moving on. It says the group operates globally with sales being made in over 100 countries. Now, we're not going to bring in IS 21 here, not yet, because if the group makes sales globally, all the companies actually are local, so they'll probably make all the sales in local currency. The group has 20 subsidiaries which have been acquired over the last 30 years. 20 subsidiaries. Can you imagine doing the console? It's going to be complex, isn't it? Yeah. However, they've been doing it for the last 30 years, so I do not see that there is a point where a risk could arise. All right. It's not a case where you have got one parent here and then suddenly they have got 20 subsidiaries. Then, of course, I would be worried that they know how to carry out the console. But in this particular case, that would not be relevant. All right, because they've been doing it for 30 years. All group companies are located in the same country, with the exception of BOSOI, a foreign sub whose operations focus on the translation of the published content into a variety of languages. So this company is a publisher. They've got 20 subsidiaries, and it looks like all the subsidiaries are involved in publishing something or the other. And you have got BOSOI here, a foreign subsidiary, which focuses on the translation of the published content of all the 20 subsidiaries, I imagine, because all the companies are involved in publishing. Let's go and just double check that. It says here that the group means all the companies within the group, all of them are publishers, and BOSOI, the foreign subsidiary, would be dealing with the translation into a variety of different languages. The group's publishing activities can be categorized into 3 operating segments, each of which are CGUs for the purpose of impairment reviews: newspapers and magazines, academic journals, and books. The revenue and total assets for the group in total and for each segment are shown as follows. Okay, so we've got the figure here. And since they've given the figures here, I just want to do something, and that is to calculate the materiality levels. So we've got the revenue figure, and we've got the total asset figure here as well. So the revenue figure is 153, and 0.5% of the revenue of 153 is equal to 0.65 million, and 1% of total assets is equal to 0.95 million. So what that means is that anything more than these figures are considered to be material, and you'll have to pick it up. Now, since we're looking at the segmental information, you can see that the revenue for newspapers and magazines are going down, and for books are also going down. For the academic journals, there has been a slight increase. And then let's carry on. During the financial year, the group has invested in software which enhances and extends the group's range of digital publications across all operating segments. The total investment, which is recognized as an intangible asset, was 15 million. So we've got this figure here, intangible asset, where the question says during the year. Okay, so remember dad's R just now. So the first D is on the 15 million, the dollar value. The second D is during the year. And we've got an intangible asset, which also involves an accounting treatment. And the 15 million is made up of 5 million, which relates to purchase software. So purchase software being called an intangible asset, that is fine. And 10 million relates to internally developed software, which is internally developed. So you can only classify it as development if there are future economic benefits. So let's read this part again. It says that during the financial year, the group has invested in software. Invested how much? So this word invested is actually the same as the word spend. So they have spent 5 million relating to purchase software, and they have spent 10 million developing an internally developed software. And my question here is, if you have spent 10 million, it cannot be that from $0 straight away to 10 million, all of it is development. So my question here is, what happened to the research expenses, which is kind of weird. So we've got point number 4 here, which is to do with the software, the internally developed software. I'm concerned that they're classifying the whole thing as an intangible asset. So the 5 million of development cost is fine, but we've got the 15 million here. So let me just calculate that. 15 million divided by the total assets of 95 million is equal to 15.8. Now let's go back up here. According to management, the implementation of this software has already led to significant increases in sales of digital publications, and while this accounts for only 20% of the group revenue, currently the management is confident that the sales of digital publications will quickly grow, and within 3 years is expected to overtake the sales of hard copy publications across all operating segments. And using this justification, management does not consider it necessary to perform impairment reviews on any of the 3 operating segments this year. Now, do you remember that in the question here, it talked about matters which the audit team will approach with a degree of professional skepticism. Now, what are these matters that we have got to exercise professional skepticism over? So I'm going to just use 3 alphabets. Q, B, C. QBC. Now, what is QBC? QBC is actually the definition of professional skepticism, where we're supposed to use a questioning mind or have a questioning mind. And since we're talking about questioning mind, what are we thinking about here? Firstly, we're thinking about management's actions. So in the question, management's actions could be the finance director has decided to do something or not do something, or you can also have a look at their accounting policies that they've already adopted. Because when you think about accounting policies, who are the people who have got a strong hand in shaping the accounting policies of the company? It would definitely be the finance director. So we're looking out for things where the finance director has done certain things, or we're looking to criticize their accounting policies. Then being alert to circumstances. So in this particular question, being alert to circumstances, what kind of circumstances do we have here? We've got the circumstances that the company is listed, and therefore they might be under pressure to maintain a certain profit figure for the sake of the institutional investors. And then after that, the last C here is a critical assessment of the evidence. So we need to go and look through the scenario to see whether any evidence has been given to us by the finance director, and we need to critically assess that as well. So if you go down here, it says that you're using this justification, management does not consider it necessary to perform impairment reviews. And we're like, really? Because revenue has gone down by 3.2%, but you know what? Revenue may actually have gone down by a bigger amount, except that it has been masked. We're talking about the individual segments have been masked by the increase in digital publications. So it could be that this newspapers and magazines, it says it's gone down. It could be that the hard copy has gone down even more and the digital publications have gone up, and therefore when you average it out, it looks like the newspapers and magazines have only gone down by 4.5%. It's a possibility. But there's also another thing here on the area of skepticism, the 10 million. We're wondering whether the whole of that 10 million is actually development costs. What happened to the research element of it? So here we're looking at the skepticism. Management is saying here that impairment not necessary. Now, on the area of the internally developed software, we've got that part about the whole 10 million has been capitalized as an intangible asset. So we're like, what happened to the research portion of it? The question also goes on to say that according to management, the implementation of the software has already led to significant increases in sales. What does that mean? That means for the internally developed software, the 10 million part of things, if it's already started to generate revenue, which means the amortization will have to come in, because amortization will have to come in when the item is available for use. Let's go back to the question. Then it says information on some specific aspects of the operations and the associated group accounting policies is given below. But before that, there's one more thing that we need to have a look at, and that is on the area of the segments. So it says that the digital sales have gone up by 20%, but it looks like they've got this number, right? They've got discrete financial information. And I'm concerned that on the area of segments, they really need to include another segment there on the area of digital publications, because the sale of digital publications is already more than 10% and therefore is a reportable segment. So on the area of Borzoi, with respect to Borzoi, let's just continue. Okay. A substantial portion of the group's newspaper and magazine publications protected by publication rights, who protect the group's exclusive right to publish the relevant newspaper or magazine for specified periods. The group owns more than 200 publication rights, which range in the period of exclusivity from 5 years to 30 years. The publication rights are recognized as an intangible asset with a carrying amount of 7.9 million. So you've got the dollar value there, and I'm going to just color that in yellow. So that's probably a point. And then it says the group's accounting policy is to amortize publication rights over an average period of 25 years. But if you look at the question, it actually says that the period of publications could be between 5 to 30 years. So why would you want to amortize a publication that has got a rights of 5 years over 25 years? You're dragging it so long, and therefore the charge to the P&L, the amortization charge to the P&L is going to be really low. So now we're looking at the Borzoi part. So number 7, we've got the publication rights, and on the area of the amortization period. So they've given us an amount there, and the amount is 7.9 million. I'm going to divide it by the total assets of the group, 95 million, and that comes up to 8.3%. And the thing that bothers me here is that the amortization is using an average period of 25 years. It's way too long. Okay, let's go back to the question. So here, the accounting policy is to amortize it over 25 years. I'm going to exercise some skepticism there because it does not make sense. Next, the group commissions authors to write books for which the group owns the copyright. When a book is commissioned, the author is paid a royalty advance, the amount of which depends on the expected sales of the book. The group's accounting policy is to defer the cost of the royalty advance within current assets until the book is published, at which point the cost begins to be recognized as an expense spread over a 10-year period. The group finance director does not have a justification for this 10-year period other than it being an industry practice. So the point down here is, fair enough, the first part has been correctly treated, which is good. They are deferring the cost of the royalty within current assets, so they're treating it as a sort of a prepayment, and that's good. But then they are going to recognize it as an expense over a 10-year period. So that seems to be a bit dubious, unless, of course, the book is going to be published for 10 years. But it cannot be that for every single author, the book is going to be published for 10 years, because you don't know what the content of the book is going to be like. I mean, if it's going to be a romantic novel, fair enough. Over 10 years would be good. But then if some of the books are to do with technology, then definitely the book will have to be updated, right? So having to drag this expense out over 10 years seems to be a ploy of the company to try and preserve their profit figure. So you've got point number 8 here on the area of the royalty advance. The first part of the treatment, that as a prepayment, is good, but the transfer to the P&L, to expenses amount, that sounds a bit dubious. That comes up to 3.6%, which is also material. So another point that we're going to put down here is that the royalty advance is now being spread over 10 years. Now, planning the answer would be important for this particular question, because the difference between part 1 and part 2 is so slim, and it looks like there might be some common areas as well, but then the marks given are different for part 1 and for part 2, and for that reason, I'm splitting it up. Next, on the area of Borzoi. Borzoi is located in Farland, a country which has recently experienced political unrest leading to significant volatility in its local currency, the ACCA. Okay, so we have got a foreign subsidiary here, and their currency here is the ACCA. So obviously it's not local currency, so that would help me think about 2 separate points. And that is, I have got the foreign so I've got Borzoi here, which is to do with the results, the foreign results. And number 10 would also be Borzoi here, but this one would be the retranslation of the assets and liabilities. And while we're at that, when you're doing this, we can also bring in another point here, and that is on the area of the foreign exchange gains and losses. On the retranslation of the foreign subsidiary, will then go into OCI. So here, they recognize total assets of 68 million ACCA, and the exchange rate is 4 ACCA to the dollar. In the last 6 months, the exchange rate has fluctuated between 10 ACCA and 3 ACCA. So it's really quite violent fluctuation, isn't it? Okay, so what that means here is that when we're doing our answer for the results here, average rates would be wrong. You would have to use the spot rate that would be prevalent on the day of the transaction itself in order for you to do the translation. All right? And for the assets and liabilities, you would have to translate it using the closing rate as at the year end. But for the moment, in March itself, your year end here is 30th April, yeah? So in March itself, today's rate, it is 4. So let's just do a little bit of a calculation here. So we've got 68 million ACCA divided by 4 would be equal to $17 million. Is $17 million material? Let's just check that out. We've got 17 million divided by 95 million, and that would be equal to 17.9%. So that's material. Moving on, Farland uses IFRS, so good, and therefore prepares its financial statements as its applicable financial reporting framework, and that's excellent. Let me just note that down here. That's good news. So what this means is that the component auditor would also be familiar with the IFRS. That's good. Next, to help with the company's development of the language translation operations, on 1 May 2017, during the year, BASSET, the parent company, transferred a piece of translation software to Borzoi. The software had been purchased by the parent company for 1.5 million several years ago, and prior to the transfer to Borzoi, it was held at a carrying amount of 1 million. this being the cost less amortization to date. Immediately prior to being transferred to Borzoi, the software was revalued in the parent company's financial statements at 5.4 million. This being the estimated fair value at the time of the transfer, which is kind of weird. I mean, first of all, this is a software. And who's ever heard of a software being revalued? And the software is old actually. And they're using fair value here, which is kind of weird because I'm not sure that, you know, if you're using IFRS 13, that there's actually an active market. So if we wanted to, we could have put down here the translation software. The translation software was revalued to 5.4 million. So we can also do that calculation here. By the way, on the area of the foreign asset here in the sub, we've got 17 million divided by 95 million here, which is equal to 17.9%. Quite a lot of points here already. And on here, we're looking at the issue of an old software that has actually been revalued, which is kind of weird because I'm sure they would have had an update by now. So that's point number 6. So let's just have a look at these points here. I want to decide which are the points that I'm going to pick up. So my first choice will be all those items that have got a maturity calculation. So that will be this one would definitely go inside my answer. This one would definitely go inside my answer. Then you've got the 3.6%. Anything more than 1% of total assets considered to be material. Then we've got 17.9% here. All right, those would definitely go in. What else would definitely go inside my answer? Definitely the foreign exchange. This foreign subsidiary, these are easy marks for us to pick up. This one would be really easy. And the part about the PPE being impaired, that's easy as well. The new client would be easy. So we should be able to get more than enough points to be able to get the 24 marks if it was a new question, that is. All right, coming back here. So it says here, the previous group auditor, Gray, states the following in their communication to Whippet. We've acted as group auditor for the last 4 years and our audit opinion has been unmodified each year. Now, even though it has been unmodified is good, but even though it has been unmodified, we still need to follow the requirements of ISO 510 that requires us to consider whether the opening balances are misstated or not. It says, however, we'd like to bring to your attention a matter to the group's corporate governance arrangements. We found that on several occasions in the last year, the group CFO initially blocked our firm's access to the group audit committee, making it difficult for us to discuss matters relating to the audit with the group, with the audit committee. But it was only initially. Okay, so the point about the skepticism here is that they might be hiding other information from us as well. Now, if you remember, the exam question for the area of skepticism was 9 marks. So 9 divided by 1.5, I've already got 6 points inside here. So you know what? That would be enough. I'm going to stop here and we're going to start writing the answer.